Hello, everybody. Thank you again for joining us a little bit earlier. So we are going to start exactly at 12. And I see quite a few people already joined us, a lot of members, a lot of non-members. So perhaps you could share in the chat where you're joining us from, Colorado, other states. So I also know that we have a very global presence right now. So there are some other countries represented as well. So hello and welcome. We're gonna start in just a second, letting everybody join today's webinar. Right. Okay, so I think we can get started. Hello, everyone, once again, and welcome to part 7 of World Trade Center Denver Trade Briefing Series. My name is Tanya Arndt, and I'm Director of Programs here at World Trade Center Denver. And I'm so glad you joined us today. Global trade is moving fast. Policies are changing and shifting. Markets are reacting, and the companies that win are the ones that stay informed and also adapt quickly. That's exactly why we're here today, to help you navigate the noise, to spot the opportunities, and prepare to what's next. Before we begin, though, I want to make sure you know about 2 big opportunities that are coming up here at World Trade Center Denver. Let me go to the next slide. First, I wanted to highlight the tariff playbook that is on September 4th and September 5th. It's you can pick one or another, so it's a one-day workshop. And this one it's not just another seminar or another educational session. It's a hands-on practical workshop where you'll learn short-term, mid-term, and long-term strategies to mitigate tariffs. You'll work in cohorts and directly with our experts one-on-one to build a customized plan for your business. And here's another thing that is so different about this one. And this is particular talking about our network here in Denver. We're actually bringing this framework of this workshop from World Trade Center Association. And I was so excited because World Trade Center Denver has been selected the only one in the US and 1 out of 7 globally around the globe to bring this very successful framework where you have a hands-on experience and working with experts as well. If you're interested, I'm going to put the link to my Calendly. Schedule a 15-minute talk with me, and I'll walk you through what you can expect and make sure that it's the right fit for you. But September 4th, September 5th on tariff strategy. So I invite you to join us. The second one is our largest, the second largest event of the year. Again, this is for the local community here in Denver. We have our annual member gathering on September 11th. It's going to be from 4 to 7:30, and we're going to focus on Colorado's global reach in defense, plus the networking opportunity. Again, it's an opportunity to connect with the global trade community. You can register. I believe there's a link in the chat that's going to be posted, but also you can go on our website or scan a QR code. For those who are just joining, or maybe they're new, maybe you're new to World Trade Center Denver, our mission here is to help businesses navigate the complexities of international trade through education, connection, and resources. And the main goal of these trade briefings is to inform and offer a variety of perspectives from different trade professionals, industries, and angles so that you can make better decisions. Quick reminder, these sessions are being recorded and you get a replay after the event. We'll have about 30 to 45 minutes of content and then 5 to 10 minutes of Q&A. With that, use your chat for general comments. and Q&A box for questions. We'll try to get to them at the end of the presentation. With that, I would love to get started, and am very excited to introduce today's presenter, World Trade Center Denver member, RSM US, and Brad Ostendorf. If you can tell us a little bit more about your company and also tell us about your speakers for us to get started. Let me stop sharing my screen here.
Thank you, Tanya. Well, we will keep this short as we have a couple of stars of the show, and it is absolutely not me, I promise. Nobody has to hear me talk for more than 30 to 60 seconds. As Tanya mentioned, Brad Ostendorf, I'm an international tax partner. I am based in Denver. Fortunately, the mind's smarter than mine, Kevin and Bryan. Neither of them are local, but if anybody on this, any of the attendees are local, would love to see you at the gathering next month and get some face-to-face time. Just good to meet some connections. As Tanya mentioned, we are all with RSM. I think the chat kind of sums up who we are and what we do pretty nicely. We really focus on what we call the the modern middle market, which I suppose is ambiguous as you'd expect it to be, and probably purposefully so. But we do focus on serving clients holistically across the globe, kind of in that, startup all the way to, kind of upper middle market, multi-billion-dollar companies in the global space. That's what we do. That's really where we focus our time. And I think we've got a lot of people like Kevin and Bryan, as resources across the country that really bring a lot of value and candidly, show really well on stuff like this. So we are really fortunate to have them. And with that, I'm going to kick it to Mr. Kevin Depew, who is our Deputy Chief Economist. Pretty heavy hitting title there. He's going to kick it off with a macroeconomic update. Kevin?
Thanks very much, Brad. Hold on one second. Let me just bring this up to the full screen. There we go. Hopefully everybody can see these. All right, very good. We'll dive right into it. It's a little bit confusing for me, although I've worked with Brad and Bryan before. My middle name is Bryan. It's spelled exactly the same way as your name, Bryan. So when Brad says Kevin, Bryan, I feel like my mother's yelling at me. That's what she used to say. Anyway, jumping right in here, we'll talk a little bit about what is starting to become the specter of stagflation light. Now, for those of you who have some experience or at least maybe know a little bit of history of the 70s bout of stagflation, I want to be very clear that the reason we're calling this stagflation light is this in no way, shape, or form is of the magnitude of the type of stagflation that occurred in the US in the 1970s. Instead, this is we're not going to have nearly the rate of unemployment. We won't have nearly the rate of sluggish growth that we had in the 70s, more than likely. But economic growth projected to slow to about 1.1% this year, inflation rising above 3%, already started making that move in the CPI report that came out this morning, which despite the stock market exuberance over the numbers this morning, I think those are more related to the Fed interest rate hopes. We still think the Fed, because of the high inflation rate, is likely to stay on hold through the September meeting. I didn't check to see what market perceptions were before the call about a Fed rate cut, but it was about 40% probability for a September rate cut. Before the data this morning, and just judging the market reaction, I think it might have risen a little bit. That said, we just don't think that the Fed's going to have enough scope to be able to say, we're comfortable with the rate of inflation. As I'm sure as this group is well aware, there was significant front running of inventory late last year and again this spring. And so many businesses that were able to do that and bring in inventory ahead of the tariffs, they're still sitting on quite a bit of goods and products that are not subject to tariffs. And so we're not seeing the full brunt of the price impact yet. So, I totally understand, that the administration is looking at this as being a real victory already in terms of the tariffs and the lack of impact that's showing up in CPI. But I can assure you that it is coming. The Chamber of Commerce, U.S. Chamber of Commerce yesterday made remarks that for small and medium enterprises, the average run rate of individual impact to businesses just based on 2023 imports for those businesses was about $885,000 per individual business is going to be the net impact. And that's going to be passed through to customers in what is basically a tax on consumers. The trade policy has increased recession probability. We're at 40% from 15% where we were before so-called Liberation Day. 10-year Treasury yield, we're forecasting it to finish right about where it is now, around 4.35%. That's even with us factoring in another 25 basis points of rate cut. And even if we were to get another 50, I think the fiscal trajectory is sufficient that we'll see a term premium applied. So that's going to keep the 10-year rates really where they are. So it will have some impact on short rates, the short end of the curve, but for longer term rates, the Fed does not set those, the market does. And the market has already spoken. In fact, if you go back to September of last year, when the Fed first cut 50 basis points and then followed that with 2 other 25 basis point rate cuts, longer duration treasuries actually went up 100 basis points. That's right. They cut 100 basis points in the Fed funds rate, and rates at the long end of the curve, 10-year and out, went up 100 basis points. So the market sets the rates at the long end of the curve. And no matter what the president says and puts pressure on the Fed chair to cut rates, that's not what drives interest rates in the United States. We do have some labor market resilience. And that's mostly because we have a demographically driven structural lack of labor supply in the U.S. So even though it's moderating, slowing to about 90,000 per month, you have tight immigration policies, which is helping cap unemployment. And that's also going to fuel some wage pressures, which is why if you think about it from the Fed's policy perspective, they're absolutely going to be too late. If that's what the president refers to the Powell, Chairman Powell, as being too late, Jerome Powell. They're going to be too late by design. That is a feature of central bank policy, not a bug. We don't want the central banks around the globe to be acting as strategists, trying to predict what's going to happen 3-6 months from now. That's not their role. Their role is dual mandate to promote full employment, which we're at, and to maintain price stability, which is elusive. And moreover, the price stability that we are seeking is changing due to some structural inflation impacts that were happening before any of the tariffs even began. So, this is an uncertain time. We can measure it. This is the Baker, Davis, and Bloom Trade Policy Uncertainty Index. This goes back to 1985, and you can see the extreme movement on the far right-hand side of this chart, an indication of just how the measures of trade policy uncertainty are truly unprecedented in the modern era anyway. This is a look at the factors that the NBER, who formally classifies recessions in the United States, this is what they look at, these measures to determine and identify when a recession happens in the U.S. Again, the NBER is not a forecaster. They simply look at these measures, and when they turn down sufficiently, then they are able to identify when a recession starts and then subsequently when it bottoms. So this will be in hindsight when this does turn down. But as you can see, we're still in pretty good shape. The probabilities of recession are more related to external factors that are not inherent in the U.S. economy. So it could be something around U.S.-China tensions, could be further expansion of Russia aggression, could be a variety of factors, Middle East disruptions that go to energy prices. All of those things have the potential to increase the probability of recession. As it is, the stagflation light scenario is one where we get close to recession, but not quite there to go into recession. Now, if you think about it, go back to March of 2022. That's when the Fed began raising rates. Every day, up until at least the election in November, every day for almost 3 years, somebody was on television saying that if we're not in recession right now, this very minute, we'll be in a recession in the next 6 to 12 months. So this is the longest forecasted recession in my career anyway. And even at 40% probability, there's just no guarantee that the national data is going to be cooperative. We had a really robust economy, which, before the start of the year, which is why our recession probability was so low at 15%. So most of the damage that is occurring potentially around stagflation, around the pricing environment, the impact on margins, the impact on unemployment, all these things are pretty much policy choices. They're not something that is happening in the economy absent policy that is increasing those probabilities. Here's the inventory cushion that we kind of talked about. And so this is one of the reasons that we have had pretty benign inflation so far. And if you think about it, I was just with a group in LA, the Swiss Chamber of Commerce. And it was perfect timing for our event, but obviously poor timing for the Swiss, who are now subject to the highest reciprocal tariffs at 39%. This goes to affect, obviously, Swiss imports like beef, for example, or chocolate, things that you would associate, but also Swiss movements. So if you think about a company like Shinola, they have proprietary handcrafted watches, but they do use, especially in their quartz watches, some Swiss movements that have to be imported. Well, they're going to be subject, the movements that they do not already have in inventory going forward are going to be subject to a 39% tariff. So at some point that will go, just as an example of one good from one country, that will go to affect even things that you wouldn't think, well, it's an American-made watch. How is this going to be subject to a potential tariff? So that's just one example of, if you have that inventory in stock, then you can kind of get by. When you run out of that inventory and you got to go back and you got to get more, then you're going to have to pay the tariff. So this is, look, I did not update this yet from today, but it had very marginal changes because these were the forecast for CPI was in line with expectations today. And so you can see the core goods there. This is the area that had been, prior to the tariffs, providing the most relief in getting inflation back down to the Fed's 2% target. And so you can see what has already happened, even with the tariffs not being fully active yet, is that goods have been increasing in price. So we're going to have a classic scenario where we have a significant amount of capital and CapEx expenditure going to items that are increasingly going to be subject to tariffs. This is the worst case scenario from the Fed's perspective, because you have a tight labor market, you have low unemployment, you have, even if in a recession scenario, unemployment perhaps rising to about 5%, which historically in past normal recessions, and by normal I mean not the pandemic, not the great financial crisis, normal recessions that happened before that, you had a significant amount of unemployment that occurred in those, where normally you'd get an unemployment rate closer to 7.5%. So now, even under a recession scenario, we're only going to get to about 5%, which is going to keep a little bit of upward pressure on wages. This is a look at the average effective tariff rate. You can see where we are going back to levels that were last seen in the early 1900s. This is data from the budget lab at Yale. I do trust this data. I know that there has been some conversation around BLS data, around the CPI data. Less confident about CPI data today, mostly because we've seen about a 45% or 40% decrease in certain time series that have been suspended because they don't have staff to cover CPI anymore after some of the Doge layoffs. Again, going to our view on interest rates, no matter what the Fed does, 25, 50 basis points, even if they cut in September and again in December, we're still looking at what our models show is about a fair yield for the 10-year. So could see some downward movement on the short end of the curve if the Fed does cut by 50 basis points over the next, say, 6 months. But you're not going to get a lot of relief in terms of rates. This is what is meant by higher for longer, and this is a normalized economy. The economy that was characterized by low rates post-Great Financial Crisis up until the pandemic was an abnormal recovery economy. That is not a normal economy. And so I understand its challenge after going through such a long period, which can, in some cases, comprise the bulk of an executive's business experience. That was not a normal economy. A normal economy is one where you do have higher rates about where we are now. So I think it's important to be able to set aside this idea that eventually we're going to quote unquote normalize to something that looks and feels like the pre-pandemic economy. First of all, I would argue we don't want that. That was a sluggish growth period up until the very tail end when some of the stimulus began to take effect after such a long period of time. But a normalized economy is one that's very similar to today, where you have industries that businesses in the same industry may be experiencing higher dispersion, meaning your experience with the potential for recession or a slowdown is going to be completely different, even if you're in the same industry. That is a much more robust, anti-fragile, normal economy. So what are some of the negative risks? These are the things that you see on television every single day. The tariff impact on inflation, government policy impacting CapEx, or at least the policy uncertainty, really creating that sense of paralysis, where businesses just we've seen this firsthand as a firm, where you have businesses that want to do some capital expenditures and invest in their business, but they'll tell us, I just am not confident right now in what the tariff policy is going to be 3 months from now or 3 weeks from now, and what the input costs are going to be in my business. I can't make a decision that's 6 or 7 figures right now, so I'm just going to defer it. These are the things that are discussed every day. What is not discussed as often are some of the positive risks. And I would argue that this is kind of the flip the script moment, even with the tariffs, even with the policy uncertainty, even with some of whether you agree with what the administration is doing or disagree, some of the chaotic unfolding of policy, that the economy is developing into a very anti-fragile, very robust economy. So I think it was prudent to skew risk to the downside in the wake of the Great Recession for a long period. And you were essentially rewarded if you were more risk averse during that period. This is one that I think is going to be more rewarding if you're more risk seeking. You have a more dovish Fed likely with a new Fed chair selection coming up. The Ukraine war potentially ending or at least easing some geopolitical tension that could go right. There will be some fiscal stimulus through tax cuts and less regulations. That will happen. And there could be additional productivity boosts extending further, lifting growth and damping inflation. So there are positive risks to the outlook. I think these are much more likely than they were pre-pandemic. So I am not of the doom and gloom camp, even if we're talking about a stagflation light scenario. Instead, we think these are policy choices that once voters get a chance to fully digest the impact of this, they'll have an opportunity to seek other policies, and we'll see how that unfolds. But whether they change policy from the voting booth or not, I think the conditions are still there for an economy that is sufficiently recovered from the great financial crisis to sort of muddle through this period of higher tariffs and higher tensions, and ultimately find a little better footing once people start to become adjusted to this new normal in terms of policy. So I'm going to turn it over to you, Bryan. Sorry if I went a little bit long there. A lot to get through here, and we'll see what you have to say on some of the more granular nature of the tariffs as you're seeing them.
Great. Thanks, Kevin. Hard act to follow, gotta say. All right, let me go ahead and share my screen. And let's get a full view going. Okay, so yes, we're definitely going to get.
Sorry, Bryan, we don't see it yet.
How about now?
Yes, just not the full screen yet.
Got it. There we go. Okay. So yes, we're definitely going to get a little bit more granular with the tariffs. Really just want to start with the headlines. I put this together and I was like, ooh, this is like trying to drink from a fire hose, just looking at all of the activity really just in things going on in August. So we'll go through this. Starting, we've had the new Section 232 tariffs on copper. And these are specific to semi-finished copper and intensive copper derivative products. So what does that mean? That covers semi-finished products like bars, sheet, pipe made of copper, and then certain derivative products. And the one I guess I want to point out, because I think that, I think, well, I don't import copper, that's, you think when I think of copper products, I think of plumbing and copper fittings and pipe and things like that. One of the derivative products that's covered by this are electrical cables. So if you're, even in machinery or technology products or anything that have cables or spare parts that involve cables, they're going to be impacted. The other point I'd like to make is that the tariff, which is 50%, is applied only to the value of the copper content. So, for example, if you are importing an electrical cable, which is, may contain a portion of copper, but maybe a sheath, insulation, and fittings, maybe some plastic fittings, that 50% tariff is only applied to the value of the copper content. Which we'll get to actually on the next slide on, well, how do you determine that? Next, we have Canada. So what's happening with Canada? The 25% IEEPA fentanyl rate increased from 25 to 35% effective August 7th. Probably the only good news with that is that the exemption for USMCA qualified goods remains in effect. So if you're importing goods from Canada and they meet the eligibility for the US-Mexico-Canada agreement, or the formerly known as NAFTA, then they would be exempt from that 35% tariff. The most recent news, China. Many of you may have been aware that yesterday we were expecting the 90-day period with the pause in the tariffs to expire. And then that was extended in the final hours for another 90 days. So we now have until November 9th. We'll see what happens over the next 90 days as far as any negotiations between Washington and Beijing. Another one, which I certainly didn't see coming, is Brazil. This additional 40% tariff also implemented under the IEEPA, or International Economic Emergency Powers Act. And this is an additional 40% on certain Brazilian goods. And this is not the same as what's known as the reciprocal tariff. This is being put in place as a result of let's just say, a beef between our president and the government of Brazil in terms of a legal case against the former president of Brazil. So we have this 40% additional, which goes on top of the normal tariffs and the current 10% reciprocal rate. One thing I will point out is that there is a fairly lengthy list of products that are exempt from this additional 40% tariff. I believe it is at the end, either as an appendix or at the very bottom of the executive orders. So if you go to whitehouse.gov, go to executive actions, you can see the executive order and see if potentially your products, if you import from Brazil, may be exempted from those tariffs. Another, kind of out of the blue is with India, 25% also under IEEPA. putting pressure on India to curtail its import of Russian oil. Clearly this is a political leverage move. We'll see what happens with that. But that 25% is stacked on top of the existing 25% reciprocal rate. Then we have the trade deals. I'm not going to go through each one, but here, just kind of a highlight of the deals that were made over that 90-day period after the infamous Liberation Day in April up through the end of July. We have the EU, UK, Japan, South Korea. You can see the rates. The one thing that is interesting is that the EU, I have there a range of 0 to 15%. What's happened is that there is a cap set of 15%. So the tariff is calculated by looking at the normal tariff rate, which is the existing most favored nation, or for any trade geeks, your column 1 rate of duty in the tariff schedule. So for example, if the existing normal rate were 2%, then the reciprocal tariff under the agreement would be set at 13%, so it would cap at 15%. That's kind of an interesting and something unique to the EU agreement. Important to always remember with these agreements, as of now, there's really nothing in writing. These are, essentially handshakes, framework agreements. There's been no text beyond an information sheet that you can find on the White House website. They certainly do not carry the same weight as a free trade agreement, so they're not legally binding, at least as of right now. And then some of the agreements do contain some concessions on the Section 232 tariffs, specifically on steel, aluminum, and potentially into the future with pharmaceuticals and semiconductors. Then we have the 40% transshipment. This is something that's created a lot of buzz, at least in the trade community, because at first there was just a lot of uncertainty as to exactly what that meant. But basically, this applies if you're importing a good, the good's produced in country A, and it's shipped to country B, and then to the United States, and you declare the country of origin as country B, not country A. Customs, and if customs suspects that that product is of country A, and they find that is to be the case, they will apply an additional 40% tariff. I think I know originally there was a lot of misinformation out there about transshipment, and I know we received a lot of questions that would go like this: if I have a solar cell and it's made in China, and I ship it to Thailand, and then they ship it from Thailand to the US, can I declare it as Thai origin? And the answer is no. You can't, or if you do, it's not lawful. And this 40% tariff is specifically there to deter that type of evasion, not to mention the potential penalties that could come from making a false statement. And then lastly, this has been an issue that's been going on for months, even longer. The Section 321, or what's known as the de minimis rule, from the big mega bill, that provision of the law allowing for goods valued under $800 or at or under $800 to enter the U.S. without going through the normal customs entry procedures and payment of duties is set, and it's still set to expire as a law in July of 2027. But since that bill was passed, the president has actually suspended use of the de minimis rule effective August 29th. So that means that low value shipments, not only from China, but from any country, will no longer be able to come in under this informal entry process. It will be interesting to see exactly how that plays out. This is going to involve a lot more customs resources. As an example, they tried to do this earlier in the year, and there were rumors that there were over 1 million small package shipments that were basically stranded at JFK Airport because there weren't enough customs personnel to process these entries that would have normally been processed as a de minimis shipment. So that was the fire hose of everything that's happened in a way within the last few weeks. So now I want to just kind of break down some of the common challenges and trends, because when all of these tariffs started rolling out, it's just been very chaotic, and it's still chaotic. But over time, now that some time has passed since February, March, April, we're now into August, a picture is starting to develop, and some of the common challenges and trends are coming into focus. So I wanted to talk about some of the issues that I've been seeing come up more and more just in my my daily work. The first one, and this is something that's mainly specific to Section 232, but it can be applied to the reciprocal tariff. And that is when you can apply the tariff to the value of content. So for example, with aluminum, steel, and copper, let's just say derivative products, you have a 50% tariff. But that tariff rate can be applied if you have the information to the value of the steel or aluminum or copper. So coming back to the cable that I mentioned earlier, if you know that the copper only makes up a small portion of the total value of the cable, you don't have to pay the 50% on the entire value. You would pay it on the value that is allocated to the copper. Now that sounds like, okay, great. We'll estimate. We'll come up with a value. That's not going to cut it. The caveat is that if you are going to assign a lower value or a value less than the entered value or the invoice price of that good, you need to be able to substantiate it. You need to be able to bring the receipts. So if you are thinking about this, or if you're already applying this methodology in order to save on these tariffs, just beware that you need to be able to back that up with good documentation. And if that value content is not known, then you need to apply the entire value of the good to the Section 232 dutiable value. The second issue that's been coming up a lot is origin determination. And origin has never, at least in my career, been more important than it is now. It is, it is what's driving the reciprocal tariffs. It's what drives certain exclusions. And, it always brings up the question, well, how is origin determined? And origin, is not determined the same way for remedial tariffs such as Section 232 or IEEPA or Section 301 as it is, say, for example, free trade agreements like USMCA. It's based on the principle of what's called substantial transformation, which means you have to, if you have a manufactured good that contains foreign inputs, you have to look at whether or not those foreign inputs have undergone a change or a transformation resulting in a new article of commerce having a new name, character, and use. And you think, okay, well, that doesn't sound too complicated. But I'll tell you, this, just that sentence alone has kept attorneys in Washington in business for decades, arguing that point because it is entirely subjective. It's not always going to be obvious that a substantial transformation has occurred. So, for example, if you have components coming from China, they go to Thailand, and they're going to be assembled into, say, a battery pack. And you have all of these individual components and they're assembled. The question then becomes, what is is it Thai origin? How much of the content in that finished product need to be Thai, or how much value added needs to occur in Thailand to make it a Thai good? And the answer is you have to apply the substantial transformation test to determine, do you have that change in name, character, and use? And also keeping in mind that this concept is not the same as I mentioned, the preferential rules of origin, which are very clearly defined in the trade agreements like the USMCA, where you have these concepts of, do you have the appropriate tariff shift or regional value content, which makes it at least a little bit more mechanical to go through the process of determining the origin and in that case, whether or not a good qualifies under the USMCA. The last one is customs enforcement. We've seen a major uptick in just overall customs activity in scrutinizing importers, either just through anecdotal stories or directly of clients of ours that have come to us. I would say I get many inquiries a week from clients saying they've received requests for information, which is the last bullet there, which are written requests from customs, typically after the fact, after the goods have entered, and it's asking for information. And often these are very pointed questions, or often they're a fishing expedition. But how you answer those is very important. Because there's typically a reason why customs issued that request for information. Almost rarely are they random. And I think that probably the largest issue here is that not only customs, but now the Department of Justice has come out and basically announced that they've prioritized enforcement of customs tariff evasion and customs fraud. And this is being done under the False Claims Act. And we've seen this just in some very recent False Claims Act settlements just over the last weeks, greater than 58 million in settlements. And then last, just something to be aware, often, I get the question, well, how does customs really, how do they find out? How do they really know? I mean, they're processing millions and millions of shipments every day. How are they really going to weed out violations? And something to keep in mind is the quitem provision or the whistleblower provision in the False Claim Act. And this is something that we're starting to see more and more of, including in customs fraud cases. And, often the quote unquote whistleblowers, they may be, an existing or a former employee, but they may also be a competitor. So, these are just things to keep in mind that, customs has ways that the information is getting to them. And then just really quickly, just some things to watch, and some of the, kind of what's ahead for us. There are, there's more in the fire hose. We have additional Section 232 investigations that are in flight and eventually will be concluding. And we can probably expect to start seeing announcements over the next months on, and I have them listed: semiconductors, pharma, timber and lumber, critical materials. We also have some active Section 301 investigations in flight. And then I mentioned here this Section 232 inclusion process. So during the first Trump administration with Section 232, there was an exclusion process where you could actually apply to have your product excluded from the Section 232 tariffs. Well, now they've turned it on its head. They've done away with all of those exclusions. And now there's a process where you can petition the government and have your product added to the scope of products that are covered by Section 232. And we're expecting the first round of new steel and aluminum product inclusion decisions next month. So that's something just to keep in mind. That could be coming, and also keep in mind that these lists of items subject to Section 232 are not static, that we expect them to grow. And then last, we have the legal challenge to the IEEPA tariffs. A lot of you may have heard that the Court of International Trade struck that down at the end of May. It was immediately appealed. And at the end of July, the U.S. Court of Appeals, or CAFC, began opening arguments. So the appeals case is in flight now. It will be, interesting to see what the outcome of that is. I think most of us believe that if the appellate court strikes it down, that it will probably go from there to the Supreme Court. And then just some quick parting thoughts. Just pointing out that a year ago, I don't think I would have said this, but now I think that tariff management has really become a mission critical piece for maintaining a business health, just general business health. And in order to do that really requires an understanding of how your company is being impacted by these tariffs, where those, and what is driving it. What are the key drivers of your tariffs? And, I think, Tanya, coming back to the very beginning, you mentioned this tariff playbook workshop. That would be, to me, I think, an excellent opportunity for companies that are really looking to get a handle on and really take control of managing their tariffs, to look to apply these things. And this type of a workshop, I think, would be really helpful for that. And then once you have your plan in place and your roadmap and you're implementing, is to really always just continue to proactively address any of that trade compliance risk that comes with it. If you're using one of these mitigation strategies, like the first sale doctrine, or maybe you've done some supply chain tweaking to your in your manufacturing process that is giving you an advantage in terms of the origin. Not through transshipment, by the way, but through legal means. But if you are taking advantage of some of these mitigation strategies, you want to make sure that you can substantiate them. So it's very important to always, be proactive in maintaining the records that you need and making sure that you're not overlooking compliance, and just thinking, oh, look at all of the money we're saving. And then last is, especially for any of you trade compliance managers out there, is to really, watch those entry summary filings. With all of this activity going on, it's, every time there's a major change, there's a lot of confusion. I've got to say, customs brokers have it really tough right now, and they're not always going to be perfect. And it's, important to make sure that you check, to make sure that you haven't underpaid, but also make sure that you haven't overpaid, because maybe there was a mistake or misunderstanding, and you may be able to go back and recover those tariffs. And before I wrap up, some useful customs resources. I find that I do go back to there are some FAQ pages on the customs website on these tariff programs like IEEPA and Section 232. I know I do tend to go back to them. I also go back to the executive orders, because right now that is all we have as a source authority. And I will leave it that. My contact information, and thank you.
Bryan, we did have one Q&A. I don't know if you can pop that up on your end and
Yeah,
Let's read the question. So that, Brad, do you mind reading the question?
Yeah, I'm not a trade advisory person, Bryan, so you'll have to do some
Yep.
explanations here. But Susan asked, for Section 232, if you don't know the value of the content of that item, copper as an example, you pay the 232 rate for the whole item. Sometimes this 232 value is lower than the IEEPA tariff. It is my understanding these are not stackable. So importers incentivized to not look into value of copper since cheaper to apply 232 rate to whole good, question mark.
So, yeah, there's a lot there. If you don't know the value of the copper content, and meaning that you would need to pay the 50% on the entire value of the article. So let's use the cable as the example. Then you would not, that's correct, you would not pay the reciprocal tariff. They would not be stackable. That is correct. Now, I'm not sure with copper, but my understanding is that if, at least with aluminum and steel, and it's quite likely also with copper, is that if you are declaring a lower value on these, so let's say you do know, let's say you have an aluminum product, let's say a shovel, and a shovel with a wooden handle, and you know that the shovel piece, the spade or whatever, is $10, and the wood handle is $5. Then you would pay the 50% on the $10, assuming you could substantiate that. But then on the $5, you would still be obligated to pay whatever the reciprocal rate is. So for example, if it were from Japan, you would pay 15% on the value of the wood handle.
Looks like Mike had a couple of questions. Brian, first one's on European tariffs. Mike's understanding is the tariffs on EU products are a minimum of 15%, and items that currently have higher tariffs keep their tariffs. Is that accurate?
Yeah. Wait, can you repeat that? That the 15% is
Yep.
the minimum?
Tariffs on EU products are a minimum of 15%, and items that currently have higher tariffs keep that higher tariff rate.
Actually, no. So I'll use like footwear as an example. Footwear historically has probably had some of the highest tariff rates in the US, into the 30, let's say like up to like 37%. If you were to import footwear from an EU country, you would pay yes, you would still pay, I believe, the 37%, but the 15%, no, sorry. My understanding is that it would cap at 15, that you would pay 15%, that you would pay no reciprocal tariff. I almost want to go back and look that up myself. I don't know if I'm able to send a follow-up confirmation, but I believe that it does cap at 15.
And Mike also had a comment on China. Is that really 10%, or is there tariff stacking, which can effectively increase that rate from the 10%?
For
China.
For China. And China for Section 232?
Does not.
So for China, if it's we'll just say if it's subject to 232, then it won't be subject to the 10%, the current 10% reciprocal tariff. But it would still be subject to other tariffs like the Section 301, and I believe the 20% IEEPA tariff.
Excellent. Thank you so much, Brian. I just want to applaud you for trying to answer on the fly here, because I think with all those, what is stackable or not stackable, I think it just shows how complicated tariffs are. And again, I just want to, first of all, say thank you to RSM for being a member. Thank you for bringing up the expertise and sharing your expertise and the passion for trade and helping all of our members and non-members to understand it better. For all the attendees, please share in the comments some of the insights that you got from Kevin. Kevin, we had you actually, this is the second time you presented, and I thought it was really good to see you again. So good to see you again. And Brian, thanks for going deep in one of those. And I know a lot of our members are dealing with that on a daily basis. So I think that's why you get those very, very pointed questions. Brad is local here in Denver. Brad, if you don't mind sharing your contact information in the chat as well. So if you have some questions, if you want to stay connected, please reach out to Brad. And if you, for some reason, lose their information, always can reach out to me and I'll be happy to connect. With that, let me see I saw some comments before. There were a lot of yeah, I see some comments as well. So thank you again. Thank you to everybody who attended this seminar today. Again, please remember Tariff Playbook, September 4th, September 5th. Reach out to me if you have any questions. Happy to answer, happy to show you all the topics that will be covered. Annual member gathering, September 11th. Hope you all can make it. And again, thank to our presenters today, and stay calm and trade on, as we say here at World Trade Center Denver. And enjoy your Tuesday, and we'll see you next time. Thanks, everybody.